Toll Brothers higher in overtime after beats on the top and bottom lines. The CEO saying demand remains solid and consistent with normal seasonality. That stock is at record levels. Joining us now is Kenneth Zener, senior analyst at Seaport. Ken, it's great to have you on. I do want to get your thoughts on this print, and particularly that commentary about in line with seasonality or normal seasonal dynamics as we see it work through the company work through the backlog, and it looks like realizing perhaps higher prices, or at least prices on more valuable homes in the quarter as well?
Right. I think the quarter was very good relative to expectations. They did beat. Margins were certainly part of that contributor at just over 29%. If you look to their guidance for next year, I would say it's good. It's certainly underpinning a positive bias for the stock, given volume. Though the margins might be down a little bit sequentially, if I read the guidance right, and that could be for a variety of reasons. Low price up, but the mix of homes, if they sell lower price homes, they will be selling more homes, and I think that's an important concept for their return on capital focus.
I realize that interest rates have come off a little bit after spiking during the last quarter, but the fact that we're still at these elevated levels and that's expected to continue into next year, have you been surprised to see housing holding up as much as it has, even as home builders like Toll swoop in to sort of help create more supply?
Not really. I mean, we take a very much of a cyclical view on this. Most of our work focuses on the pre-1982 period. And when you see a secular rise in interest rates, what we saw in the mid-60s forward, you do have tight existing supply. The job environment is still very healthy. Certainly, builders are helping buyers with incentives such as, 2-1 mortgage buydowns, which Toll is doing. But it also benefits from those, being a trade-up, more luxury-oriented home seller. It is benefiting from those existing sellers in a tight market. They're able to move their equity over. So, in addition to upgrades that help its margins as well.
Ken, existing home sales have been slow. How much risk is there to a name like Toll that those actually pick up and it causes a shift in the balance between supply and demand?
Right. We haven't really agreed with the bearish concept that more existing supply is A, about to come on, or B, would significantly undermine margins profitability for the public builders. It just doesn't rhyme with history as we've looked at it. I think a healthier housing market, as opposed to a tight one, would not be a bad thing within a historical context.
So is the gauge really strength in employment then in the areas where Toll is operating?
I think, yeah. I mean, it's pretty diverse builder. I think, the fact we have almost a 4 handle at unemployment, still strong job growth. Upwards of 30% of its buyers are cash purchasers. So it has a good demographic. Obviously, the stock market is not undermining confidence for its affluent buyers.
You've got a buy rating, a $93 price target. Stocks trading near or at all-time highs right now.
Yep.
Why do you buy?
Well, we did upgrade about half of our stocks November 2nd on our de-inversion with rate coming down concept to give, investors a view back to the 1950s, actually, on that. But at 1.2 times forward book, it's not as expensive, quote unquote, as some other builders due to its lower returns on capital. But if you look at Toll, this 1.2 valuation range on forward earnings is still at the attractive end of a 1 to 2 times historical book valuation.